So I'll turn over to Dan, and then he can go a little bit more detail into the numbers.
So return on equity is effectively the return on investment figure. We'll all agree that we want return rates to be as high as possible all the time. Conversely, we have to agree that at no point do we want our capital sitting around in the bank doing nothing, making no returns or negligible returns, whether that's from investments or operations. Obviously, the caveat to that is that we want enough in the bank to do things like service our debt coverage or have cash on hand in case of a downturn, or if our CFO gets gambling addiction. But aside from that, even given a conservative buffer, you really don't need excess cushion sitting around in the bank. That money should be put to work. It should be used to expand the company, make acquisitions, or in the case that we're proposing, value creation by going out and buying back shares in the market, retiring them to subsequently increase our holdings in the company and also our share value. We have market statistics available to us that allow us to see what our peers are doing in the industry and make decisions on what dials to turn to adjust our own financial picture. We could see right off the bat that operational efficiency, as Chester said, it's almost twice as much as our peers. Meanwhile, our ROE is a third of our peers, and it's really not a picture that makes sense. It shouldn't be happening, but it's an easy fix.
Why is our operational efficiency so much higher than our peers?
Well, we have a healthy company. Right now, our net income to sales is such that we don't have we have a healthy margin, and our asset turnover is really not as high as our peers, and we just have more margin for less volume, more margin. So when we look at this breakdown, when you break ROE down into these three different components, as Chester mentioned, net income over sales, which is our operational efficiency or our return on sales or margin, and sales over assets, which is our turnover asset ratio, and then our assets over equity, which is our leverage. You can see right away by looking at it in our middle column, our asset turnover ratio, there's plenty of room to move. We immediately can make a significant difference by making this adjustment with our assets to go and bring down our equity. And then you can see in the right column, our leverage is way out of whack, and we are extremely under leveraged. By taking our assets, we're going to show you with utilizing some debt to make for an optimal equation. We're going to take our own assets, bring our asset and equity down, and effectively boost our leverage equation over twice as much as it is now to give us a net effective of almost a 3 times ROE from where we're sitting currently.
Okay, I can grasp that we can leverage operations, but why do our sales to total assets suck so much?
Well, that's the thing, is that we have too many assets sitting in the bank right now, and that's what we're actually trying to explain today, is that our assets are sitting around doing nothing. Other firms have their assets out there working, and that's what we're going to explain. How this picture can be easily adjusted. So on that note, to speak more to the debt, Justin and Ian are going to explain a little bit more about how the debt to equity mixture needs to be in order to most effectively make this happen.